Welcome to the Multiple Time Frame Momentum Trade Strategies course, where you're going to learn a simple but very powerful strategy that I think will become a very important part of your trading plan. As you know by now, I'm Robert Miner, the course creator, and this is the third course in the complete Dynamic Trading course curriculum. Each course builds on the principles and execution of what you learned in the prior courses as you learn to develop your trading as a business. I've been looking at indicators almost since I began trading over 30 years ago. It wasn't until 10 or 12 years after I began trading that I developed a practical trade strategy to integrate a momentum indicator into a trading plan that included simplified Elliott wave and dynamic price and end of wave price target strategies. So maybe you're like me in my early years of trading, believing that there is one special indicator with unique settings that will always reflect the price cycles and give advance warning of reversal and trend targets. I found this was not the case, as I'm sure you have, but eventually I did find a practical application of momentum indicators based on the multiple time frames, or subdivisions, that are the basis of Elliott wave trade strategies. My approach to multiple time frame momentum trade strategies is a powerful filter to identify strong and weak markets, as well as a signal for specific trade strategies that should become an important part of your trading plan, as it has with mine. There's been hundreds, maybe thousands of articles written about indicators, whole books written about them. But very little of that information comes from a practical, day-by-day, real-time decision-making strategy standpoint, and recognizes that a price indicator should never be a standalone signal for market position and trade execution. It can only be used in the context of a complete trading plan that also includes pattern and price position. Well, you'll learn in this course that it doesn't really matter what price indicator you use, because they all give you about the same information. And there's no specific or magic settings, and you'll be able to quickly discover which are the best settings for the market and time frame you are trading and the price indicator that you're using. You're going to find out how it's not nearly as complicated as a lot of people make it or want you to believe that it is. So the multiple time frame momentum strategy is going to help you identify the trend direction and also the trigger to execute a trade. So it's going to be some great information that you're going to integrate with the pattern and price analysis that you've already learned. So let's get started and learn the basics of what an indicator represents, what is momentum, and then continue on and learn some practical trade strategies. How they relate to the price. This is the 13-period rate of change with a 5-period smoothing, or 5-period moving average of the raw data. And we can just see, once again, it's pretty, now it becomes pretty obvious what's the trend direction. Is it positive? Is it negative? It's reasonably smooth. It makes turns fairly near the highs and lows in price. So let's take a look at another indicator, and we call it untab these so we can look at two of them at once. This is a stochastic. It's in every charting program available, or it certainly should be, any charting program that has indicators, because stochastic is a very popular indicator. And it's a really good one to use for our purposes as well. So this is a stochastic indicator against 13-period look back. Look how similar these two look. The stochastic is basically taking a 13-period rate of change. It's not exactly that, but it's similar to that. But look at how similar the two of them are. So they're basically showing about the same thing, the trend of the rate of change. Now, the little difference in the stochastic is that we have what's called overbought and oversold areas. We'll get into that a little bit later. But the main demonstration here is a stochastic indicator is very similar to a rate of change, as we'll see all indicators are. I'll bring up the properties of this, and then we'll put the smoothing, or put the raw data on. And let me click OK on that. So the green line is the smooth line. It's similar to the red line in the rate of change. And the red line here in the stochastic is the raw data. So we can see how they cross over. And you'll learn how to use these crossovers at a later time. It's just very similar to moving average crossovers. That's essentially what we have here, as if we had moving averages on the chart. So again, the rate of change indicator, it just has what we call a zero line. And if any value is above zero, that means it's a positive rate of change. If it's below zero, it means a negative rate of change. And even though, for instance, at this period where my cursor is, even though the line is advancing, it's below the zero line, so it's still a negative rate of change based on the look-back period, but it's reducing the negativity, shall we say. It's starting to become less negative, and then eventually it becomes positive. So the main lesson here, momentum indicators, almost all momentum indicators, represent the rate of change. There's no magic indicator. Key is to understand the indicator, understand the different settings, and how to look at the settings in the indicator to determine what are the best settings. In this video, let's take a look at several indicators, take a look at some of the similarities and differences to them, and take a look at which ones might be best for how we want to use those indicators. I just want to remind you once again that there is no one indicator that's the best indicator all of the time. And if you have an indicator that you've used and you're familiar with its strengths and its weaknesses, just continue to use it. What we will do through this course is show you how to integrate that into a trading plan. So let's get started. This is some gold daily data. And these are three indicators. Now, in the last lesson, we looked at the stochastic and the ROC, or the rate of change. And I basically just included those two on this chart as well. And below it is a very popular indicator called the MACD, Moving Average Convergence Divergence. And we show that because a lot of people use that to identify trend direction and potential reversals when the market is either getting weaker or getting stronger, which is what all of these indicators help us to do. So let's look at these three first and just briefly look at the differences. Here's the ROC. We looked at that in the last lesson. And again, there's a midline. And if the indicator value is above the midline, that means the value is positive. If it's below the midline, that means the value is negative. We've also got two lines. One is the red line is the raw data. The green line is the smooth data, meaning we're just taking a moving average of the raw data. And then, of course, we have crossovers. Just like if we had two moving averages on the chart, when one moving average crosses over the other moving average, it indicates the market is probably at or near a trend change. And as you can see, a lot of times there's these little quick crossovers that then are eventually come back. Ideally, we want to avoid those, and if we had the perfect indicator of all time, we would avoid those, but those are unavoidable for all indicators. And we'll get into more specifics about that later. But for this indicator, is the value of it is, it basically follows the trend of the market. It tends to turn around the times of price trends. So always the question is, does it give us information in advance, or is it a lagging indicator? In other words, is it a leading indicator or a lagging indicator? Is there something about the indicator that if a certain value is reached, it's warning us of a trend reversal or some sort of change of trend? And just being above or below the midline is not a warning of any sort, because there's no upper boundaries, there's no lower boundaries. Now, when we have a crossover, that starts to warn us. That's like a short moving average crossing over the longer moving average, and it indicates that at least the speed of the trend, in this case the rate of change, is lessening. Doesn't necessarily mean a price high or low, but it would be a warning sign that a market is maybe coming into a price change. So it's pretty good to follow along the market. It gives us advance warning, usually if a trend is slowing down and possibly in the position for a trend change. And again, once it's smooth, it follows along with that trend pretty good, as it should, because it's showing the rate of change. So it should be more or less the same shape as the price trend is. Okay, here's the stochastic. Very similar to having a rate of change, and a smooth rate of change is calculated a little bit differently than just a strict rate of change. I'm not going to go through the calculations for any of these. You can find the specific math formulas for most indicators online. There's whole books that's been written about indicators and, which ones may be used for certain purposes. As we're going to see eventually, you should just choose one indicator for all your purposes. So the stochastic, again, it's like having a two-period moving average, or a smoothing of the raw data. We've got two lines. In this case, the red line is the raw data, and the green line is the smoothing of the raw data. And again, we have crossovers of the two lines. But here's the main difference, what we have. We have what's called overbought and oversold zones. Because the indicator's values is limited between 0 and 100. That's just the nature of how it's calculated. And so an overbought zone is a relatively high value. And if we have pretty good indicator settings, if a market reaches overbought, for instance, it may be a warning that it's nearing the end of that momentum trend, at least. So it has some value, some leading value, by having an overbought and an oversold zone. And we'll see later on how we can really take advantage of that. So that's a key difference here. That makes it, to a certain degree, a leading indicator. Now, it's not by any means perfect, because the main weakness is in a strong trend, as with any indicator. It's essentially, let's look at this period, it's overbought and remains overbought for an extended period of time. So reaching the overbought zone is not necessarily a warning that we're within bars of completing a price reversal. And that's why when a market gets overbought, and we'll look at that in a lot more detail later, is we only consider the overbought condition as a warning we might be nearing a price high. And then we either have to look for an actual reversal of the indicator, or else we want to see the indicator, in this case, decline below the overbought zone before we consider it a good setup for a price reversal. Talks lots more about that. But we can see with these particular settings is that it's relatively smooth. It generally reaches overbought and oversold right around the time of the price reversal. So momentum reversals and price reversals do not necessarily coincide with each other. But if we have a good indicator and the settings are more or less optimized, and I don't like using the word optimized because that has a lot of negative connotations, but they're more or less set so that most of the time the indicator reaches overbought and oversold. So let's go down and look at the MACD. The MACD, Moving Average Convergence Divergence, does just what its title is. It's looking at a couple different moving averages, and it's looking at how close they are, how close they converge or diverge with each other. And so for instance, this is displayed as a histogram. If these bars are increasing, that represents a strong, in this case, bull market. So it means those moving averages are diverging from each other because the short-term moving average is getting further from the longer term, and it just represents a bull trend. If we have them begin to decline, it's just a warning that the rate of change is lessening. And again, in advance, and then it comes down. What does it mean when it crosses below the midline? Well, it means that the moving averages have crossed. The slower one has crossed below the larger one. And there's a whole there's been books written about how to use the MACD to identify probable continuation of the trend position and warnings and all of when a trend may be in a position to either reverse price or at least slow down in price. And so a lot of people will only trade if the MACD line, for instance, is positive. They'll only trade on the long side at least, and they just won't take a trade if the MACD is negative, or else would only consider short trades. So it's a pretty good trend following indicator. But the one drawback it has is it doesn't really give us a warning of if the market's in a position, coming into a position to make a price reversal. It lags the price reversal somewhat, but it does warn us when the rate of change is lessening. That's when they're converging. These lines get smaller, and certainly when they get below the line. But they're not quite as effective to pinpoint if it's making price cycle highs or lows. But if you're using MACD, and if you've been using it for years, and if you know its characteristics, it can be useful. Let's look at some other indicators. So in this chart, again, I have 3 indicators, and all 3 of these indicators have 2 lines. All 3 of these indicators have overbought and oversold zones. And actually, let me make these thick. Just one moment. I didn't have these thick, just so we can see them a little bit better. There we go. And the 3 indicators I have is the RSI and stochastic, which we saw a little bit earlier. And these are 2 of the most popular, most used indicators for all markets and all time frames, the RSI and the stochastic. Then the bottom one is called the DT oscillator. This is an oscillator that's unique to the Dynamic Trader program, which I developed and we use in this course. It's very similar to a stochastic, as you can see. In fact, you can see all 3 of these indicators more or less show us the same information. They all have overbought and oversold zones. They all have two lines, which means that the raw data or the data in one form or another is then smoothed, or we take a moving average of it to smooth out the trend of the line. And then we keep the raw data or a shorter term look back, whatever, so we have crossovers. And all three of these tend to reach oversold or overbought, top zone or the bottom zone oversold at most of the price reversals. Not all of them, but most of them. So any one of these three is going to be very useful to us for our dynamic trading, time, price, pattern, momentum, trade strategies that we teach in the course. Which one would be the best? Well, I'm partial to the DT oscillator just because I've been using it for 20 years. So, and it's reasonably smooth. Most of the time it reaches overbought or oversold. It hangs overbought or oversold a little bit less during strong trends. But I certainly know that most of you don't have the DT program. So you're going to learn how to use basically any of these indicators. But I'm going to focus mostly on either the RSI or the stochastic when I'm not using the DT oscillator, because I know they're in every charting program. There's lots and lots of training material out there for both of those indicators, but you can certainly use another indicator that you're familiar with. Now, all of these are helpful, and our purpose for using the indicators is to warn us of when a price reversal or when a market is in a position for a high probability position to make a price reversal. And of course, we integrate the indicator position and reversals with our price and pattern as well. When we have an Elliott wave pattern that looks like it's getting near a position to make a reversal, when it's reaching an end of wave price target, then we use our indicators as well to identify, is it indeed in a position to make a reversal? And you'll see specific trade strategies, how we can use an indicator actually to trigger us into the market, as well as to identify the relative strength or weakness of the market. So all three of these are pretty good, pretty similar as far as reaching overbought and oversold. And I think a key to any indicator is you really need an overbought or oversold zone, because those are the zones that warn you that a market is reaching a position to make a reversal. At least most of the time it does. In this lesson, we're just going to go over some basic terminology that we'll be using throughout this course, and I want to make sure we're all on the same page with the same terms, so we don't have to go into detail about them at a later time. I mentioned earlier that price trends and momentum trends don't always trend together in the same direction, and that's because a momentum trend represents the rate of change in most price indicators, at least. And if that speed of the trend or the rate of change of the trend slows down, a bull trend, for instance, can continue, yet the indicator may be declining or be in a bear trend. Let's just take a look at an example of that. And I'm going to focus in on just a short period of time of this data that I'm showing here. This is, by the way, Tesla. No, it's not. That's the NASDAQ daily data. It's all the same for every time frame. Let's look at this period right here. For these 5 or 6 bars, this bull trend continued and the market continued to advance. Yet, right around this point in time, is the momentum began declining. So we have price advancing, momentum declining. So they're diverging at that point in time. And so what exactly does that represent? Well, it represents that during this period of time is the rate of change or the speed of the advance began to decline. So the market continued to advance, but relative to the look-back period at least, the rate of change was declining or being reduced. So that's how we can have a divergence between the price trend and the momentum trend. Now, typically, that doesn't last too long. And in fact, it's a real warning sign that the price trend is nearing the end when the momentum trend begins to diverge with the price trend. So it's a sort of wake-up call that there's a possibility, good possibility, you want to be alert to a price reversal that's upcoming. So that's how price and momentum trends can diverge. And with that said, there are a particular strategy also on price momentum divergence that can be used to your advantage when making some trading decisions. Let's just go down and look at this data. We had a decline and then a momentum reversal to the bullish reversal, and the market went sideways for some time. And then the price declined to a new low, declined quite sharply. And then at this point in time, what do we have here? We have a swing low in the momentum, which is higher than the prior low, yet the price is at a lower low. Again, that is a bullish divergence, price momentum divergence, and that's a warning that a good potential, the market's making a price low, and there's buying coming into the market. So when momentum and price, their cycle highs and lows, when they diverge, and in this case, when the price is at a lower low, but the momentum's at a higher high, that's a pretty good signal that the market's at or near a reversal. And it's just the opposite up in this period of time where we had momentum made a high, but price continued up for several more bars, and momentum was at a lower level. So again, that's a bearish divergence between price and momentum. So those are not things that we make a specific trading decision of, but they're good pieces of information to be aware of if a market is coming into a price or a pattern position to make a reversal, and we see that the price and momentum are at a divergence. It's a real good alert, at least, that a reversal is possible at those price and pattern targets. You'll hear a lot about momentum, bull, and bear reversals. What do we mean by that? So again, this is one of the reasons that we use, or at least we prefer, momentum indicators that have ranges from 0 to 100, so we have overbought and oversold zones. A bear reversal is when the relatively fast line crosses to below relatively slow line. So these are always two different look-back periods, and usually the slow line, again, is a smoothing or a moving average of the fast line, which is typically the raw data. But in either case, when we have two lines, because they're different look-backs or they're calculated differently, whatever, when the relatively sensitive line closes below the slower line, that's a bear reversal. And because in this case, for instance, this bear reversal on this daily momentum was made in the overbought zone, we would say that this market made a daily momentum bear reversal in the overbought zone. And then let's follow this line further down, and at this point in time, right where this bar is this market made a daily momentum bull reversal from the oversold zone. And it made a bull reversal because the fast line traded and closed above the slow line. So that's what we mean by bull and bear reversals, because we also have just price bars, bull and bear reversals. But that's why I always preface it with the daily momentum made a bull reversal from the oversold zone. And usually also describe it with what the initial look-back period is. So in this case, it's 8-bar look-back period. So the daily 8 momentum made a bull reversal from the oversold zone. So just keep in mind those terms, bull reversals and bear reversals, overbought and oversold, and then price momentum divergences. So we'll be referring to those terms throughout this course. Well, let's continue on into the next chapter and talk about different indicators and how to identify the best settings for whatever indicator that we're using. In this lesson, let's take a look at a few different indicators and how we might decide what settings we'd want to use for that indicator. So a couple of things to stress before we get started is, number one, once again, there's no one indicator that's the best to use for all markets and all time frames and all types of trends. So once again, if you're already familiar with, for instance, the stochastic or the RSI or the MACD or CCI or whatever indicator, use that indicator and we'll kind of look at it logically and how we would use it with a pattern and price relationships to help identify reversals of momentum trends and cycles as well as price trends and cycles. And then the second thing to stress is there is no one set of settings for any indicator that's going to be optimal for all types of market activity, such as a strong impulsive trend or a typical correction or a trading range. No one indicator setting is going to be optimal for all those different types of market trends and corrections, and we never know what sort of trend or correction is going to unfold into the future. So we can always look at past data and say, here's the best settings that would have been perfect for that series of data at that period of time. But is that series, are those settings going to be best for the future time when we don't know what sort of market activity is going to come to us in the future? So we have to choose some settings that are useful for most types of market activity, whether it's a trend or a counter trend or a very strong impulsive trend or a mild trend, that sort of thing. So we look at different series and periods of data. We look at different settings and then say, well, this would have been pretty useful regardless of whether it's in a trend or a counter trend or an impulsive trend or a correction. So let's take a look at the data I have here. It's just gold daily data. And all three of the indicators that are at the bottom of the chart, all three are stochastics. And they're all three different settings, from relatively short look back to a relatively long look back. And of course, the shorter the look back period that you choose for any indicator, the more sensitive it's going to be to reversals of price trend and momentum cycles. So a couple of things also to emphasize before I get started is one of the primary purposes of the indicator is to help us identify the end of a correction. Why do we want to get real good at identifying the ends of a correction? Well, when a correction is complete, the trend prior to the correction should continue to a new extreme. So just like we focus a lot on pattern, on identifying the end of a correction, and on price targets for a correction, well, we're going to use that indicator to help us identify if a correction is in a position to be complete and what would be the trigger based on the indicator that it's complete and set us up for a high probability specific trade strategy. Okay, we're back to stochastic, relatively short look back, medium, and longer look back. If we just look at these indicators below this data, which we have a variety of different kind of trends and counter trends over this period of time, what seems to just stick out as be fairly obvious, I should say, follows the kind of price cycles within this series of data. So the fairly short look back looks pretty good. It doesn't oscillate between oversold and overbought all the time, but we can see clearly defined reversals bull reversals, bear reversals. If we just look at the data, they're within a couple, 3 bars of where the price reversal was. And when it does reach the oversold or the overbought zone, that's usually in a position where it makes, let's call it a higher time frame reversal, a reversal that lasts for longer time periods. And then again, here it oscillated to overbought, fairly significant advance, back to oversold, up to overbought, and then it drops out of it and makes reversals, etc. So that looks reasonably, that could be reasonably useful. What about the little longer look back in this stochastic? Well, the longer look back flattens it out quite a bit, and it also lags the price reversals by more than just a couple of bars. So I don't think this would be real helpful to us, and it doesn't reach oversold or overbought zones until the trend is well underway, very mature, let's say. And then here's the even longer look back period. So that might have been useful just to identify, let's call it the more major trends or the higher time frame trend in the market, but wouldn't have been much use for us to be positioning on the minor corrections within the trend, because it really had very few crossovers until it reached, in this case, the oversold zone, and then reversed up, and then had no crossovers before it reached the overbought zone. So we'll look at another way to help us identify a higher time frame trend using indicators, and then how we use the lower time frame indicators settings and indicator trends to position in the market. So right now we're looking at position in the market. It sure looks to me like this would be the relatively short look back would be the most useful. So what I'm going to do is I'm going to do what we call tab these. Let's make sure I have this window the maximum size. I do. So if this has been useful for this set of data, it should be useful going forward to help us identify when we might want to position in the market. And also keep in mind, we never have our trading strategy solely reliant on the indicator. We're looking at pattern and price position, and then frequently the indicator is the trigger to identify the reversal and when that trend or counter trend is complete. So let's add some more data. I'm going to just advance the data here for several weeks or months. And again, we had a strong and consistent bull trend, and then a fairly consistent bear trend as well. Well, during this bull trend, of course, the indicator hung in the overbought zone a lot because it was an impulsive bull trend. But if we look at this, each time that the indicator then dropped out of the overbought zone and made a reversal, didn't necessarily have to reach the oversold, but just dropped out of the overbought zone and then made, in this case, a bull reversal, that usually indicated the end of a correction, in this case, fairly short-term correction. So that occurred right here, was overbought, dropped out of the overbought zone, made a bull reversal. The trend continued. It was the end of a correction. Again, went into the overbought zone, hung in there for quite some time, and dropped out of it. Then it did make a bull reversal right here and just went sideways, and for the first time then flipped back around to bearish without having gotten back into the overbought zone. Trend has probably reversed. And again, strong decline, got into the oversold zone, and then made a reversal from the oversold zone, and then trended directly up into overbought. So if we were looking at this bar by bar, would we have identified from the indicator alone that this was a higher time frame low, as opposed to just a temporary low and we're going to have a 3 to 5 day correction or something? No, the indicator would not have helped us with that. It would only indicate that if it reached the oversold zone and made a bull reversal, and then particularly once it exited the oversold zone, that it had made a low of some sort, and it would really be our price and pattern position that would help us to indicate how important and what time frame low would be. For instance, if we just look at this data real quickly, we can see it looks like a perfect 5-wave decline was made into this indicator reaching oversold and making a bull reversal. So that might have been a pretty good trigger to indicate wave 5 was complete. And then a higher time frame advance was going to occur other than just a 3 to 5 day correction, which is exactly what happened. So once again, as we continue through this course, we'll see how we actually use the indicator to help trigger us at least into trades, as well as identify the probable position of the market, whether it's at or near the end of a correction or at or near the end of an impulse trend, that sort of thing. But right now we can see this indicator, the stochastic, could have been very helpful in this market. And the stochastic indicator is very popular with traders. And it's just a matter of the settings and what settings help you to identify when a market has completed a correction, when it gets into an overbought and oversold zone, particularly with the stochastic. It's usually indicating that that's the trend of the market. That's the higher time frame trend. And we want to look at any time it dips out of that extreme, overbought or oversold, and then makes a reversal, and what is the follow-through and not the follow-through. So how did I arrive at these particular settings? Once again, I just brought up the menu for the settings for the stochastic, and I just adjusted them up and down a bit, such as that. We can see until it looks like they've pretty much cycled with the price cycles and dropped in and out of overbought and oversold zones. So you can play around with those, and that's all that I did. And also, I wanted the settings so the reversals were fairly clear. The crossovers is what I mean by the reversals. And most charting programs, see, that's all I did. Just moved them up and down until I got where I could see the cycles. Most charting programs, then you can set alerts for when they make a crossover. And that's what I do, is I set alerts on the program and on the particular chart so that it alerts me whenever an indicator makes a crossover on any chart that I have and for any time frame. Well, this is also daily gold data, and the indicators below the chart, these are all RSI indicators. And again, I've got 3 different look-back periods and 3 different smoothing periods to show on the chart. They all look kind of similar, don't they? It's very much like the stochastic. And in fact, these 2 indicators are relatively similar, but they're the 2 most popular indicators that traders use. And if I look at these different look-back periods, similar to the stochastic, the longer look-back, this is the 21, it doesn't seem to make the kind of signals quite as well defined at least, as the shorter look-backs. So I would be focusing on either this 8 look-back or the 13 look-back. And between the 2, there's not a lot of difference. They both tend to cycle from overbought to oversold. And by the way, notice these overbought and oversold lines. I think in the stochastic, it's more typically around 70-30. With the RSI, it's more typically around 60-40. And again, there's whole courses out on RSI and using different configurations of it, different settings. But we just want it to help us get an understanding. If a market is near an extreme, then what is it? Indicate a reversal signal that reversal has been made in price as well at the end of a trend or the end of a correction. And very similar to the stochastic, let me just go ahead and untab these so we can be looking at just the one RSI here. If it's in the overbought zone, and then if a market comes down out of that overbought and makes its reversals, its bear reversals here, if we had some indication that the trend had reversed to bear, it'd be great setups on the short side. Again, pops into the oversold zone, out of it, makes a bear reversal, Again, then the market continues lower. Now here it made a bull reversal. The indicator itself would not indicate that the higher time frame trend is reversed. Most indicators, they don't do that. But if we had, for instance, well, this is another one, looks like we might have finished a 5-wave decline here, or something along that order. If that's the case, and we're looking for a reversal in the higher time frame trend and reverse to bullish, then we'd look for our indicator to help us identify the end of corrections. For instance, here it was oversold, and if we have some indication that the higher time frame trend had reversed, this would be a great setup to have identified that a minor correction was probably complete. Popped into the overbought zone, helps us to identify that the higher time frame trend is bullish, came out of it, and then made a bull reversal to continue the bull trend. Back into the overbought zone, and then kind of sideways, and then down and down. The fast line just touched the oversold zone and then made the bull reversal, indicating that potentially this correction was over. And then, again, the indicator went and hung into the overbought zone, typical of a bullish trend. Made a reversal, and this is called a double reversal, and this is on a slight bearish divergence. A lot of these indicators are used to identify relative strength and weakness of bullish and bearish divergences. Then when it declined out of the overbought zone, more than likely the higher time frame trend reversed. Okay, so they both, RSI and stochastic, are similar indicators, and we'll see how when we look at them in the perspective of the time and price position, they can be quite valuable to trigger us into trades or to adjust our stops. Let's look at one more indicator. So this is the similar data that we were looking at. So this indicator is the DT oscillator, the dynamic trader oscillator, and it's a momentum indicator that's in my program Dynamic Trader. And it's similar to these other indicators. The major difference here is it does tend, if you get the settings right at least, to oscillate from overbought to oversold a little more clearly than it does with the stochastic or the RSI. So I really focus on using this indicator, but we'll take a look at both this one and RSI and stochastic as we go through the course. But it does a pretty good job, particularly of identifying the end of corrections and then making it a bullish reversal, in this case from the oversold zone during this higher time frame bullish trend. But just like all the other momentum indicators, if it's a strong impulsive trend, it hangs for a while. A lot of times it'll oscillate in the overbought zone, and a strong bull trend are in the oversold zone and a strong impulsive bear trend. So that's the weakness of all momentum indicators. So we just have to live with that. We have to choose what is the best settings that are going to be helpful for us most of the time. And similar to when we looked at the stochastic and the RSI, the relatively short settings pretty much identify pretty well, at least, the fairly short-term cycles of these corrections, and it would be very helpful for us on its bullish reversals and the bearish reversals for a bear trend to enter at the end of a correction. Again, we don't make a decision based solely on the indicator, but we'll see how we use that information with our price and pattern information as well. So that said, you can see how you can put one indicator up, put several different settings, and just see which one do you think would be the most helpful given different sort of trend and counter trend corrections, trading ranges, that sort of thing, different sort of market conditions. And don't try to over-optimize. Just do the settings so that, particularly if it's around corrections, it typically gets a bull reversal or a bear reversal if it's in a bear trend. But we really wanted to focus on it helping us identify the end of corrections, because as you can see with all these indicators, if it's a strong trend, an impulsive trend, getting into the overbought zone, in this case in a bull trend, is not an immediate indication that we're making any significant high, because the impulsive trend can continue for some time. We really want to use it to help identify the end of corrections. Okay, let's continue to the next chapter and see how we integrate the momentum indicator position with the price and pattern position for specific trade strategies. The key to identify high probability trade setups and high probability trade strategies is multiple time frame analysis and multiple time frame trade strategies. Well, you already know the basics of multiple time frame, maybe by another terminology. Maybe from Elliott wave. Multiple time frame also relates to different degrees of trend, larger degree, smaller degree. For instance, within Elliott wave, let's use an example. If impulsive trend is being made, and it looks like it's nicely breaking down into 5 sections or 5 waves, typically, if it's in the 5th wave, that's the final section of that 5-wave impulse trend. Ideally, that 5th wave breaks down or subdivides into a smaller time frame of 5 waves itself. So if we can identify the subdivisions of the wave 5, and when that smaller time frame, smaller degree 5-wave trend is complete, then that indicates that the higher time frame trend is complete. So again, the terminology in Elliott wave is different degrees of trend, very similar to how we speak of different time frames or multiple time frames. So let's take a look at how we use momentum and multiple time frames, because this is something that is rarely used and rarely taught. I began teaching it many years ago. This is an approach that is so powerful and the concept so simple, both to understand and to implement, that I can't believe that every single trader in the world doesn't use multiple time frame momentum trends as an important part of their trading plan. But it's relatively unique to our dynamic trader community and dynamic trading type of trade strategies. So let's take a look at it and first understand it and then see how we apply it for practical trade strategies and practical trade decisions. So this is the euro-dollar weekly data. So the basic strategy is we look at the higher time frame momentum trends and momentum cycles to identify the trade direction, and then we use the smaller time frame momentum trends and cycles and reversals to actually identify the specific trade, to position ourselves in the direction of the higher time frame trend. So this is weekly data again of the euro dollar. I've just got a couple indicators on this chart. One is just your basic stochastic. It's in every charting software available, and as well as our DT oscillator. Now we can see both of these tend to make reversals at about the same time. So they're both equally useful to identify the higher time frame or weekly trend of the market. The only difference is typically the DT oscillator reaches the oversold, overbought cycles between those two extremes. Stochastic doesn't, but it makes its reversals about the same time. So again, what we want to do is trade in the direction of the higher time frame or the weekly trend. Let's just look in this area for right now. Both the stochastic and DT oscillator made what we call bull reversals. That means the fast line crossed above the slow line. So as long as the fast line is above the slow line, we have a bullish momentum trend, and we only want to consider trades on the long side of the market as long as the fast line is above the slow line, or we have a bullish momentum trend. Now, they diverge a little bit during this period of time. This is basically a sideways correction. But regardless of which indicator we're looking at, we would either stand aside this period of time if we're just using the DT oscillator, or we'd still focus on long trades on the smaller time frame daily cycles. But pretty much they're telling us the same thing. Again, bullish, bullish, bullish. Still, they're up through this point in time, they're both bullish. This fast line's above the slow line. They are in the overbought zone. That's a warning to us that probably the euro is getting near a higher time frame top. But as long as the fast line is above the slow line, it's an opportunity to go long. Once it crosses below, then that's when it's reduced its trend and maybe even reverse trend. Well, it's definitely reversed the momentum trend, and we would not want a position on the long side. So certainly as of this bar, we would not want a position on the long side. It looks like it's about a bar later when the stochastic made its reversal. And then a few bars later actually declined below the overbought zone. So real simple. We trade in the direction of the higher time frame momentum trend, and we execute on the smaller time frame. So let's take a look as of the last bar in this chart and use that as an example. As of the last bar of the chart, the weekly momentums made bull reversals. No surprise. Look at that huge outside bull reversal day or bull continuation day. Looks like a new closing high, new high, and both of the momentum indicators reversed to bullish. So as of that point in time, that's the week ending June 6th, we'd only want to consider long trades as long as the weekly momentums remained bullish. So let's take a look at how we'd use this. So this is the daily data as of the Friday, November 6th, when the weekly momentums made a bull reversal. The daily momentums are overbought. Again, I've got the DT oscillator and the stochastic. It's just to show you it really doesn't matter which indicator that you're using, which momentum indicator you use. They both cycle and trend about the same. Some lead a little bit, some lag a little bit, but they're both equally useful. They're both in the overbought zone. So if they're in the overbought zone, do we want to initiate a long trade on that bullish reversal in the weekly? Well, the answer would be probably not, given they're in the overbought zone, and that usually warns that this market is near at least at what we call a daily high. A daily high would be followed by a daily momentum bear reversal, sideways to down probably 3 to 5 days. What we want to do now that the weekly momentum is bullish, we want to go to the smaller time frame daily momentum, and when the daily momentum cycles and makes a bull reversal, then the daily and the weekly momentums will be bullish, and that's what we call a dual time frame momentum setup to continue the higher time frame weekly bull trend. It's pretty simple stuff, isn't it? Well, let's add some data onto the chart, and we'll watch the daily momentum. In this case, that's the smaller time frame momentum. Watch it cycle, and when it makes a bull reversal, that's when we have a dual time frame momentum position to develop a specific trade strategy to enter on the long side, because we have a bullish weekly momentum and then we get a bull reversal in the daily momentum, dual time frame momentum setup. Let's add some data. There, we've had about 3-4 days. There we go. As of the last day on the chart, looks like the DT oscillator made a bull reversal. Doesn't look like the stochastic has yet. I suspect if we're one more day sideways to up, it will. But this is now a specific dual time frame setup, not to immediately go long because we don't get the signal till the end of the day, but we can now develop a specific go long trade strategy. What I like to see is once we have the dual time frame momentum setup, that's the setup. And then the entry trigger would be some sort of follow through on the next bar. In this case, the next day. So follow through can be a higher close. It can be exceeding a minor swing high, something that indicates that we've made the bull reversal and the momentum. Now let's see if the market's going to follow through. So it's pretty simple stuff. It's very logical. So let's just draw a line against that high. So if the euro should advance above that high and make a higher close the next day, that would be a specific entry. Where would the stop be if that's made? So we can develop the whole strategy in advance so we just automatically execute. Well, where should the market not go if indeed we've had a good dual time frame momentum setup to continue the higher time frame weekly bull trend? Well, it certainly should not go below the low made prior to the momentum bull reversal. That's where we put our stop. So entry above the little swing high or a higher close, stop below the last swing low made prior to the momentum bull reversal for a probable continuation of the trend to above the recent high. So let's just add some data. There's one more bar. Just got stopped into the market with a long trade with well-defined minimal capital exposure. We've got both DT oscillator and the stochastic daily momentums have made bull reversal while the weeklies momentums are bullish. That's what's called a dual time frame momentum setup to continue the higher time frame weekly bull trend. I just added some data here. The market basically went sideways for several days and then, as of the last bar, made another dual time frame momentum setup to continue a weekly bull trend. So that would be another setup. You might add long positions. At the least, think logically now. This would be conditions to adjust the stop on an existing long trade to where the low was prior to the most recent daily momentum bull reversal. We'll get into specific trade strategies later, but you can already see this is brain dead simple, and it's so powerful. I don't know why every trader in the world isn't using multiple time frame momentum strategies as a significant part of their trading plan to identify high probability trade opportunities. Okay, now you know the basics of what we mean by dual time frame momentum trade strategies. We're going to get into a lot more detail. I'll just mention you can have more than two time frames. We could have even gone down back here when it had the daily, weekly momentum setups. We could have gone to an intraday data for that trigger to get into the market. We'll look at some of those later on too, where we're looking at triple time frame momentum setups. And once again, we do these within the context of the pattern position and the price position as well. We'll integrate that into our multiple time frame momentum cycles and strategies in the future lessons. In this lesson, we're going to explore how we use the dual time frame momentum position and cycles to adjust stops in a market as it progresses. The last lesson you learned how we identify trade setups by the dual time frame momentum position and reversals and entering the trade. Now, how do we manage that trade if it continues in the anticipated direction? And again, we're going to look at this out of the context of any other technical position, out of the context of the pattern position or the price position, just so we can get a handle on how to use dual time frame momentum to our advantage. So I'm going to begin. The first example is we'll just continue on from that euro example that were the setup for the entry we looked at in the last lesson, and we'll follow it through, and then we'll look at a couple of other examples with different markets and different time frames. So this is the daily data as of the end of the last lesson, where we entered the market above this little swing high. That's why I have it as a thick green line. with a stop below the swing low prior to the entry of the market and prior to the last daily momentum bull reversal. And I've got the same two indicators on here, the stochastic and the DT oscillator. So this market has continued to a new high, and it's made another daily momentum bull reversal just prior to making this new high. So before I continue, I'm going to pause this, or ask you to pause this for just a minute or two and think about what would the general concept be here on how we would adjust stops if the market continued to advance in the anticipated direction. How would we use the higher time frame momentum and the lower time frame momentums for a basic dual time frame momentum trade strategies? So I'm going to ask you, pause this playback, think about that. Just in general, don't get paralysis of analysis, just the basic strategy that you might think would be useful. Okay, you've restarted the playback. What did you come up with? Well, let's look at the concepts here. Concepts and basics are always very, very important, because if you're well grounded in the concepts and the basics of exactly what, in this case, dual time frame momentum means, you'll come up with a basic trade strategy. So we want to trade in the direction of the higher time frame trend, in this case, the weekly momentum. If the weekly momentum reaches overbought, it's at least a warning, it's a wake-up call that maybe the weekly momentum is nearing a position to make a top, a weekly high. That would mean a reversal and then be sideways to down for several weeks as it makes that weekly momentum cycle. So we continue to trade and even continue to consider adding to the position as long as the weekly momentum is bullish. In each smaller time frame, daily momentum bull reversal could put the market in a position to adjust the stop to the low made prior to the daily momentum bull reversal. And as long as at least the weekly momentum, the higher time frame, is not overbought, any lower time frame daily momentum bull reversal could be a setup to either add to long positions, go long if we're not already long. Once again, we don't have to buy the ultimate low, sell the ultimate top. We just have to be in a position to where the market is going to continue the trend based on our technical analysis and our probable position of the market. So a quick review. We trade in the direction of the higher time frame trend. In this case, it's the weekly trend. As long as it's bullish, we can consider long trades. Once it reaches the overbought zone, though, for most indicators at least, it's at least a warning that we're in the final stages of that weekly bull trend. We execute following the reversals of the smaller time frame, in this case the daily momentum bull reversals, execute on the long side and consider adjusting our stop closer to the market, to the low that was made prior to or in coincidence with, possibly at the same time as the daily momentum bull reversal. Well, let's add some data on here. And again, we're looking at this out of the context of the price and pattern position, but we're keeping it simple, and we're going to see how valuable this basic strategy could be to integrate within the whole of our trading plan. I'm going to add some data on this daily data. So there are daily momentums made a bear reversal. So if the next daily momentum bull reversal is made without having traded below the swing low prior to the swing low at the last daily momentum bull reversal, that's pretty positive, isn't it? Higher highs, higher lows at each daily momentum bull reversal. Let me add some data on here. Well, it didn't even really make a cycle there. It just continued straight up. So again, our stop would be no further back than below this swing low. Would we want to adjust it yet because of this bull reversal that was made at this point? Well, that's to a certain extent an executive decision, because the momentum didn't come down anywhere near the oversold zone or even make a real cycle. But let's just think logically. If the market's going to continue bullish, what should it not do? Well, after this big up day, an immediate follow-through probably shouldn't come below this low. So that would be a good place to adjust or stop, and that's where the last daily momentum, at least with the DT oscillator, bull reversal was made. The stochastic has remained bullish all through this time. Now, it is overbought, but as we know, the stochastic tends to remain at the extremes longer than some of the other momentum indicators. So yes, a great place to adjust the stop. I'm just going to do that right now, and I make that look red and thick. So if by chance the euro turns around and were to take out the stop, we'd still be guaranteed at least a small profit on this market. So at what point do we maybe want to get more aggressive about adjusting the stop based on the dual time frame momentum position? Well, if the weekly momentum were to reach overbought, we would then want to be aware of that, because that would indicate we're probably in the final weeks of the bull trend. We may adjust our position if that should occur. So let's take a look at where we're at in the weekly data, because the position of the weekly momentum is also going to give us some ideas on maybe how to trail that stop even closer to the market if it looks like we're near a weekly momentum high in bear reversal. So I'll go back to the weekly momentum. As of the last bar in the daily chart, that was the week ending December 18th, and we've had a 5-week advance. The weekly momentums, both the stochastic and the DT oscillator, are overbought, and they have been for 2 or 3 weeks. So we're near an extreme probably from where we make a weekly high and a weekly momentum bear reversal. Now, we don't want to guess when that's going to happen. What we really want to do, at least this is my suggestion, is we trail that stop closer to the market now that we're in a position to potentially complete a weekly high. So we don't need to come back to the weeklies right now because we know they're dual look back overbought. Let's just adjust our stops on the daily and be fairly aggressive on adjusting those stops on the daily. So here's the daily momentum on the DT oscillator. The fast line's overbought. It looks like on the stochastic is both lines are overbought. So we're in a position to complete a daily high. Now that we're in a position to complete a weekly high, we may want to be more aggressive than waiting for the next whole momentum cycle. Again, when we integrate the pattern and price position, it will give us a better idea of how aggressive we may want to be once we reach these extremes. But I think just given that the momentum cycles have been overbought for several weeks, I'd bring it up to the last little low just prior to making that new high. I mean, this market's either going to continue bullish or it's not. And if we have that breakout to a new high, and then if it were to come down and trade below the breakout to the new high, more than likely that higher time frame weekly trend is complete. Let me add that on. Okay, let's add some data on here. Continued to advance. The daily momentums it looks like they both made bear reversals as of this day. Wild day this was, wasn't it? Big decline, and yet it closed up near the higher of the day. Didn't hit the stop yet. Let's just continue to add some data. Essentially sideways. Inside day of an inside day. And as of the last bar in the chart, our daily momentums have made bull reversals. So that's a reason to adjust the stop, isn't it? Our weekly momentums, we know as of this time, have been overbought for several bars. So we should be near a weekly high just based on the momentum position. So let me continue to add some bars on this chart and think about this. Boy, new high, strong reversal, bear reversals. Let's add some more bars. Another bull reversal. Where's the low prior to this bull reversal? Well, it's up at this low. So I'm just going to add that in. We're adjusting the stop closer to the market. Very logical reasons. Boy, this has just been a significant bull trend. But there we are. As of the last bar of the chart, we would certainly be stopped out of our euro position, taken almost 2 months ago, it looks like. Let me clean this up a little bit. So this is a great example of, and this was a very consistent and impulsive bull trend. I mean, this is the dream of all traders, to be in a just a consistent bull trend, higher highs, higher lows. Nothing really strange happened here, no real crazy volatile days other than this one, real typical kind of corrections. And that's certainly not the outcome of all markets and all time frames by any means. But the point is, here we made decisions very logically just based on the dual time frame momentum position, where we had the weekly momentum determine the direction of the trend. And as it got overbought, then we got a little bit more aggressive with advancing the stops in the market based on the cycles, the momentum cycles of the daily momentum. Well, let's take a look at another example. Well, here's an example using the ES. I trade that a lot. I like to trade the daily cycles, sometimes the weekly cycles, but the daily cycles are 3 to 5 days, something like that. Sometimes it ends up being a longer term trend than that. But I first focus on the position on the daily data and the daily momentums, and then oftentimes go down to the intraday momentums to trigger me into the market. I certainly don't sit and watch intraday data all through the day, but once the setup has been made on the higher time frame, either weekly or daily, then I can set some alerts on the intraday data when the intraday momentum gets in a position to make a reversal and then to consider a specific trade strategy. Okay, here's the ES. This is the daily data, and as of the last bar in the chart, we can look. I've got 3 different momentum indicators down here. They're all saying the same thing. This is the DT oscillator, the RSI, and the stochastic. They all made daily momentum bull reversals as of the last bar of the chart. Well, it's no surprise. Look at this bar. This is what we call a snapback reversal day, where it opened near the lower third of the range and then closed near the top third of the range. And not only that, it even traded higher than the last bar, and it closed above the closes of the last 2 bars. That's a 2-close bull reversal, snapback bull reversal. So that said, we're focusing on momentums, but the momentums made a bull reversal. And I just got this one line drawn in here. This is the line across the swing low made prior to this new low. And so as of the last bar, the ES has come up and traded into the closing range of the last decline. What does that mean? Out doing any fancy wave counts. As you know from the Elliott wave course, that's a closing overlap. It's a pretty good signal that a correction is complete. And when we just consider that, how simple is that, along with the daily momentum bull reversals, in a great position now to consider a long trade for a probable daily trend that would last usually about 3 to 5 days, net bullish. I always say sideways to up, maybe longer, and potentially to a new high, indeed, if this is a corrective decline. So just based on momentum and simple pattern position, great opportunity here, probably at least. So what we do is we go down to the 240-minute data. I usually, when I'm looking at intraday data, I'm looking at 240 minutes. Sometimes I'll go down to 60-minute. 60-minute is as short a time period that I use for looking at momentum and momentum cycles. So we'll get down to 240-minute data, and let's see where we're at. Well, this is the 240-minute data, and it's just a few bars past this daily bar. This was this wide range snapback reversal day on the 240-minute data. Came down a bit, made a new high, and then kind of sideways to down for a couple bars. But as of the last bar in the chart, at least on the DT oscillator here, very similar to the stochastic, it made a bull reversal. So that means the daily momentums are bullish. They've just made a bull reversal the prior day. And the 240-minute momentums are bullish. That's dual time frame momentum position to continue the higher time frame daily bull trend, which we anticipate would continue for 3 to 5 days or so. So it's a great setup to consider a long trade. And what would be the trade strategy? Very simply, just as we discussed in the last setup, when we're looking at weekly and daily data, if we take out the swing high made prior to the bull reversal, that would be a go-long setup, and the stop would be just below the momentum low, the price low at the last momentum bull reversal. So we have, in advance, we know our well-defined entry strategy and stop strategy. Now, there's some of you out there who may be fairly new to trading, and you go, oh my gosh, this is a long way from where this reversal was made. I can't trade that. The stop would be too far away. Well, number one, the stop's only at this low. And number two, if you can't absorb that risk for your account size, just use an ETF. You don't have to trade the futures. You can use the futures data or even the cash SPX data to identify the trade strategies. And if the leverage is too much for you, just use an ETF. But take advantage of the information, because if indeed this is a daily low, and if indeed it was a corrective low, then eventually the S&Ps will continue to advance to above the high. So that's quite a bit on the upside for a stop entry and a stop level right here. So let's put that in. Let's see what happens. And then see how we might manage the trade. And in this case, based on the daily and 240-minute data. So this would be our go long. I'm going to color that green. And this would be our stop. Now that's just assuming that the market continued to advance and it made that new high. If it went sideways to down and we had another whole rotation in the 240-minute oscillator, then we'd have to adjust the strategy. I'm going to add some data on here, bar by bar, use our training mode. There we are, made the new high. It was the follow-through to the daily momentum bull reversal and then the next 240-minute momentum bull reversal. Took out a new high, stops at the prior low. Let's add some more data. And each time the 240-minute momentum makes a bull reversal, that will place the market potentially in a position at least to consider a strategy to adjust the stop. And again, this is just based on dual time frame momentum. We're not considering the price or pattern position, that sort of thing. So there we go. We made another new high, another momentum bull reversal. We'd adjust the stop up to the last swing low made prior to that momentum bull reversal. We'd still have a slight loss if we got stopped out, but it would be really a small loss. Let's add some more data. Oh boy, he just had a really strong advance. So there we made another momentum bull reversal, and we made another new high, adjust the stop again. We're now insured at least a small profit on this trade. Now we might want to go back and let's check out where the daily momentum is, because remember, we're trading the daily momentum cycle. And we could be using actually triple time frame here. We could be looking at the weekly momentum. If it's still bullish, we might be adjusting our stop at a different rate. But I'm going to stick with just the daily and the 240-minute. So I've advanced the daily data to where we were on the 240-minute data. That's several days after the entry, and this is March 15th. We had just made a new high, just as we had with the 240-minute data. But here's what we want to take a look at is down in the indicator section. It looks like all of our indicators are overbought. Looks like only the fast line of the DT oscillator is overbought, but slow line's almost there. RSI is stochastic. Both of them have been overbought for a couple of days. So that's at least warning us that the ES should be near a daily high. And a daily high is followed by sideways to down for 3 to 5 days or so, depending on the higher time frame, whether it's a correction or a reversal to a bear trend. Either way, we're looking to exit once the daily high is complete, and we know we're probably pretty close to that. So we'd want to be maybe more aggressive, definitely at each of the 240-minute momentum bull reversals, adjusting that stop, trailing it closer to the market. So let me go back to the 240-minute data. And by the way, I almost never, I can't even remember the last time that I would exit a market at a price target zone. So I always want the market to indicate it's making that reversal by taking out a swing low once we're near the extreme of the higher time frame, something along those lines. So that stop, that's why I say I trail the stop, not exit the market at a price target or a specific technical target. So as the last bar in the chart here, we made another 240-minute momentum bull reversal and a new high on that bull reversal. So again, based on just the dual time frame momentum position, we'd want to adjust the stop, trail it closer to the market. So let's just keep adding some data and see how we might use our dual time frame momentum position to adjust stops. Now we know as of this blue bars, that was the bars where the daily momentums were all overbought. So we know we're in that position. So we're not going to get tricky or fancy. We're just going to look for any 240-minute momentum bull reversal to trail or stop a little closer to the market. And there we go. We need another bull reversal, a swing low, a new high. Let's add some data. It just got stopped out. So long above this swing high, relatively quickly adjusted the stop close to the market. Relatively quickly, within a couple of days, we were in a net profitable position, and then we just trailed the stop as the market continued to advance, recognizing when the higher time frame daily momentum was overbought that we were probably near a daily high. And as we know, in a strong trend, it can stay overbought for several days, and which is what it did. We still trailed this stop at each lower time frame 240-minute momentum bull reversal. Again, we're not really considering price and pattern position and other technicals, but just the logic of dual time frame momentum strategies, both to identify a high probability trade and then manage that trade if the trend continues as anticipated. Let's look at a couple more examples of dual time frame momentum trade strategies, again, out of context of any other technical information, our fundamental information, our pattern, our price information. And of course, we would be integrating those as part of our trading plan, but we want to get real solid on the value and how to use the dual time frame momentum position for not only identifying potential trade opportunities, but as well as adjusting stops if the trend continues in the anticipated direction. Well, this is weekly data of Verizon and covers a several-month period fairly recently. And it's been a fairly choppy period for these several months in Verizon. I've got the DT oscillator here and the RSI, and you can see they pretty much trend and reverse at about the same time because, once again, what are they? They're both momentum indicators. They're both crunching the rate of change over the given look-back period. So they should act and react about the same. As of the last bar in the chart, they've both made a bull reversal from at or near the oversold zone. So they're both telling us that more than likely the Verizon has completed a weekly low. It doesn't tell us at all whether the next weekly trend, if it develops as warned from the bull reversal in the weekly data, is going to be just one of these 2 or 3 or 4 week advances, or it's going to be a higher time frame, multi-month advance. But what we do know is that this is an opportunity to consider Verizon long position for a probable 3 to 4 week trend, if not longer. So the next step, we know where we're at with the weekly data. We go down to the daily data as of the time it made the weekly momentum bull reversal, and then identify daily momentum bull reversals to put the daily and weekly momentums in sync to continue the higher time frame weekly bull trend. So I'm just going to focus on one of these indicators. We don't need to have them both up. I wanted to show them both to you to show you that, once again, almost all momentum indicators trend and reverse about the same time. I'm going to use the DT oscillator just because that's the one I'm most familiar with. But as of the last bar in the chart, it's kind of irrelevant. They both made bull reversals. And what I would do is I would set an alert for when the weekly momentum became overbought or made a bear reversal. So it would alert me to that, the higher time frame position is in a position to make a decision. Now, do we really need an alert on weekly data? Since really all we got to do is look at it once a week. Friday after the close, look at where it's at. That's good for the next week. But we might want to set those alerts, and all software programs, charting programs, trading programs should allow you to set alerts on any technical indicator. So I set an alert, the DT oscillator gets overbought, and I've set an alert in the event it makes a bear reversal. Okay, let's take a look at the daily data as of August 9th. So here we have the Verizon daily data, and we've got, again, DT oscillator and the RSI indicator below the chart, and we can also see how they trend and reverse about the same time, plus or minus a bar at each of the reversals, but they're pretty close to reversing at about the same time, would give us about the same information, the same bull and bear reversals. But we're going to focus on just one, and I'll continue with the DT oscillator. The RSI is giving us the same information. So this says of the last bar in the chart, and the daily indicator is that's when the week that the weekly momentums made a bull reversal. So as of the last bar in the chart, the daily momentum is bullish. The fast line's close to the overbought zone. So it's 2 or 3 days. It's about 3 days off of when it made the bull reversal. It's probably near a daily momentum high. So what I usually say, the language I use is the upside is probably limited before it completes a daily high. So the ideal setup from my point of view is we wait several days until the daily momentum makes its next cycle and its next bull reversal. And that will be the immediate dual time frame momentum setup for a long trade. So let's just add some days onto this chart. We don't need to have this much data on the chart, by the way, because we're really only interested in this next daily momentum bull reversal. So there we are as of the last bar in the chart. The Verizon daily momentum has reached well into the overbought zone. More than likely, it's at or near a daily high. There it made a bear reversal. Boy, it's popping up and down all over the place. It's right back into overbought. Again, I'm waiting for this. We're waiting for the momentum to get down at least near the oversold zone and make a bull reversal for the dual time frame weekly daily momentum setup. And what I usually say, for instance, in my reports, I would say back at this area, I'd say at the next daily momentum bull reversal from below the midline. In other words, it needs to decline for 2 or 3 days in a typical correction, get below the middle of the momentum zone before it makes a bull reversal and a legitimate dual time frame momentum setup. So let's add some data. There we go. As of the last bar in the chart, Verizon has made a daily momentum bull reversal from pretty close to the oversold zone. And the weekly momentums are bullish. Boy, it even looks like ABC correction, doesn't it? And then it's had this big update closing into that range. So Verizon, as of the last bar in the chart, is in the ideal position to initiate a go-long strategy based on the dual time frame momentum setup. Now, with stocks, ETFs, cash indexes, my entries and protective stops are almost always based on the close. The close is important for stocks, cash indexes, and ETFs. So the entry strategy would be the next higher close. Now, since this looks like a perfect ABC, we've got a well-defined swing high, it could be either a trade above this swing high or a higher daily close. And where would the stop be? Real logical, real simple, the low made prior to entry, prior to the daily momentum bull reversal. So the stop would be this swing low or this close. And I would usually make it a close below that closing low. So let's add some data. It may be fulfilled, it may not. Possibly Verizon will go sideways to down, never make the higher close. Well, it did. It made the higher close and opened above this area, a gap opening. So let me give you a couple comments to that. A lot of people are afraid to enter on a gap opening. To me, a gap opening represents I'm on the right side of the market. This is a market that's got some buying power in it. I want to get in it right away. So certainly by the close, we're long. If not, if we had a buy stop above that swing high, we'd be long in the open. And where's the protective sell stop? Well, the close the low close made prior to entry, prior to the daily momentum bull reversal. So I'm going to take the worst case scenario here and say we're long on the open, and this is our protective sell stop. So let me make these thick in the proper colors. So as long as the weekly momentum is bullish, we want to adjust the stop each time we make a daily momentum bull reversal. And as long as the weekly momentum is not overbought, each time the daily momentum makes a bull reversal, in most cases at least, that's another setup for go long. So we could add to the position. We'll be adjusting our stop to the swing lows made prior to the daily momentum bull reversals, that sort of thing. Well, let's add some data and see how we'd manage this trade using primarily just our dual time frame momentum position. So let's add some data. They've added one bar. Nice follow through. We like to see that. So before we even continue, we can outline what our strategy is. Our strategy is the next cycle and bull reversal in the daily momentum. Number one, as long as the weekly momentum is not overbought, that would be another opportunity to go long on a dual time frame momentum setup, and then also to adjust the stop on the existing long position. So let's just keep adding some data until we come to an event to which we would make a trading decision. So the daily momentum's made a bear reversal from the overbought zone. That's not an event to which we adjust the stop yet. We want it to make a bull reversal, and generally a bull reversal from what I call it below the midline. So that's how I usually phrase it in our DT reports, is the next bull reversal from below the midline is an event to which we would then make a stop adjustment or an entry. Because if it makes a bull reversal from right around the overbought zone, then the follow through the upside is probably fairly minimal. So, okay, let's add some data. We're still in the overbought zone. We're still just below the overbought zone. Oh, look, made another bull reversal. And as of the last bar, made a bear reversal. So this is a powerful market, obviously, that the daily momentum has been hanging in the overbought zone and oscillating right around it for some time. So technically, we haven't had the type of momentum cycle and daily momentum bull reversal where we adjust the stop. But let's be a little bit logical here. And let's make a trading decision, hopefully based on just some logic and experience. Needless to say, we're this far away from the entry spot, is that we want to protect this position. And I would look at this, what we call it a bear reversal day, but the market then just immediately flipped around and went higher. And that was the low close just prior to this bull reversal. So really, if this market is in a bullish position, it shouldn't come down to this. We could do some price relationships and that sort of thing, but we got to protect this position and basically guarantee we're going to make a small profit at least. So I'm going to adjust the stop to that point. And again, I don't want to bring it too close to the market until the market's in a position to complete a higher time frame reversal. So let's add some more data on the chart. So as of the last bar in the chart, the daily momentum has reached oversold. Now, that's not an event to take action yet, but if it does make a bull reversal, then we're going to adjust our stop to the swing low made prior to the bull reversal. As of that bar, it made the bull reversal. Here's our stop adjustment. Pretty logical. Close below that closing swing low. So again, we've trailed the stop a little bit closer to the market. We've ensured a little bit more profit if the market does move against us. Now, what day do we have here? This is on a Thursday, the 19th. Let's take a look at where the weekly momentum is. Well, this is the weekly data, and this is the last complete week prior to that, the last day on the daily chart. And the weekly momentum has reached overbought. So we definitely don't want to initiate any additional go-long trades following daily momentum bull reversal. We want to use those to adjust the stop closer to the market, because more than likely, we're within a week or two of completing a weekly high. So let's go back to the daily data and just continue to manage this trade until we're stopped out. So there we go. As of the last bar in the chart, the daily momentum, well, the fast line's overbought. We've made a new high, made a new closing high. Is this an event to which we would adjust the stop on the market? Well, not based on dual time frame momentum. No, we'd have to wait till the next daily momentum bull reversal. In the next chapter, we'll be looking at integrating pattern and price position with our dual time frame momentum. So I'm sure as you've looked at this data, there's a pattern relationship that might allow us to and dictate to us to bring the stop much closer to the market. Certainly looks like a 1, 2, 3, 4, and 5, like we made a new high in a wave 5. So when we integrate pattern position and potentially the end of wave 5 price position, we may adjust the stop much closer than below this closing swing low. But let me add some more data for now. Bear reversal, sideways for a couple of days. So the fast line of the daily momentum has reached oversold. If the daily momentum makes a bull reversal without being stopped out, that'll be another event, dual time frame momentum reversal, that will then dictate to us to adjust the stop closer to the market. And boy, haven't made a bull reversal yet. There hasn't been an event that says adjust the stop. There we go. We just got stopped out of the market on the close, since the stop was a close below this level, this closing low. Let me just put that in before we continue on. So here's what the new and amateur traders would say. My gosh, you were at a new high and you gave back so much of the, and here's the terminology a newbie would use, is you gave back so much profit. They may even say open profit. There is no profit until you've exited a trade and you sold at a higher price than what you bought. That's what a profit is. And it's not, you're not giving back anything in this situation, because you made a decision based on your trading strategy. And sometimes that maximizes where you capture the vast majority of the trend. Sometimes you give back, or your gain is reduced substantially from what it might have been, just because the technical position didn't allow you to adjust your stop. So it's just the way it goes in trading. We still had a reasonable profit on this. It wasn't a lot, given that we were in that trade for over a month, maybe 5 or 6 weeks even, and it did continue quite a bit higher before it turned around and came down and stopped us out. But again, that's what trading is all about. It's following your plan and not having regrets that you didn't capture the low tick and the top tick of the trade. Let's take a look at another example, and let's just use the stochastic indicator. This is a series of data. It's weekly data for IYR, which is a real estate ETF, very popular ETF to be traded. And this is weekly data for more than a 6-month period, kind of essentially sideways, a bit choppy. We would call this sideways with a bullish bias. It's probably just slightly up over this time period. So let's just take a look and see what settings might be helpful for this period of time. And if we find those that are helpful for a particular period of time, we have to assume going forward that those would probably continue to be helpful. One thing that's really interesting is that where price cycles may not be so obvious from one period to another period, for instance, this period, they're very obvious. In another period, they might not be so obvious, but the momentum cycles tend to continue. In other words, that ebb and flow of the relative change of the market. Those cycles, momentum cycles, seem to continue, and so they continue to be helpful. So here we are with the stochastic. I've got it below the chart. And let me make sure I had the size up on the largest we can get it. They're a little bit larger. So I just bring up the stochastic properties, and I usually start with around the 833. That usually is a pretty good setting. And then I'll just adjust them up and down a bit to see if they tend to be more helpful. For instance, if we get up to the 13 look back, it flattens out quite a bit. Okay, so I want it to be a little bit more sensitive so we can recognize those momentum cycles a little bit better. So I'm going to put it back to 8, and then you can kind of play with the percentage K and the percentage D until you get some obvious crossovers and the fewest number of what we can call false reversals, where I actually don't see many in this chart, but it's where they would cross over one bar and then immediately cross back the next bar. That's what we want to kind of avoid. Now, with the stochastic, generally doesn't cycle between overbought and oversold. It will typically, the stochastic will reach the extreme in the direction of the trend. So if the trend is net bearish, or excuse me, if the trend is net bullish, then during the cycle highs of the momentum, at least, it will frequently get into the overbought zone, even hang in there for some time. But then if the trend is net bullish, it typically won't cycle down to an oversold zone. Of course, we could always just adjust to the line that we consider for oversold. We just don't need to do that. Let's just look at what we have here. Looks pretty good as far as it makes its reversals, which are the crossovers, it looks like, within a bar of the typical, the price reversal anyway. And then it pretty much hangs on the right side of the market during the trends for most of the trend. And of course, the majority of these bars are positive because the trend was a little bit net bullish. So that's the weekly. So let's go okay on the weekly. Then let's take a look at the daily for around this same period of time. Find what are the optimal settings for that period of time, or at least good settings. I don't know if there's ever any optimal setting. And then we'd assume that those momentum cycles with those settings would continue into the future. So this is the daily data for that same period of time, more or less. And here we've got the stochastic indicator and the 833 settings. So it tends to cycle from overbought to oversold, but since it's such a relatively short look back, it also hangs in this case, the overbought area for quite some time during these bull trends. And it also, there's quite a few of these little false reversals, what I call false reversals, in the midline, or the mid zone, we could call it. So I would prefer to have this a little bit smoother, have less false signals, and pretty much cycle smoothly from crossover to crossover. It may not be from overbought to oversold, but at least between the crossovers, we don't have a lot of these little false crossovers. So let's just add, I'm going to do a look back here at about the 13. That smooths it out a little bit, and then I'm going to increase these a couple, and that's very typical. So now just look at it. It's just visually you can look at it, and it looks, well, that's pretty smooth. And you can look at the highs and lows and where the crossovers are without getting paralysis of analysis and just say, well, it looks like it made these crossovers within a bar or two of the price highs and lows. So it can be relatively useful. We can look at this period, really choppy period, and frankly, there's nothing that's going to help you a lot in here because this is an unusually short and choppy period, and that's not the typical type of market activity for most markets, for that matter, and plus for this market as well. So if you optimize, so to speak, for this period of time, then the indicator is not going to be useful for the majority of time that has these other types of price cycles and momentum cycles. So these settings look pretty good to me. What we got to assume is, well, going forward, they're going to be useful as well. So we have our settings for the weekly and we have our settings for the daily. So let's go back and to the weekly data and look for some weekly reversal that would be a signal on the side of the market we want to trade, and then we'll go into the daily data and see when we have the actual trade setups. And again, just based on dual time frame, weekly and daily momentum cycles, not considering the price or pattern position. So I've just gone forward a few bars on the weekly data until we got a weekly momentum bull reversal. And we did as of this last bar in the chart. So it looks like typically, at least for the last several months, if we get a weekly momentum bull reversal, we have a minimum of 2 to 3 weeks. It's followed by 2 to 3 weeks of net bullish activity. So that's a great trade setup. And on the long side, we probably only want to consider long trades. This probably wouldn't be a market we'd want to short because the higher time frame trend is bullish. So let's go as of the week ending January 15th. So let's go to our daily data as of that period of time and then see when the daily momentum reversals, bull reversals, would put us in a position for an immediate go-long trade strategy. Well, here's the daily data as of the Friday, January 15th. This is the date when the weekly momentum made a bull reversal. And again, once it makes a bull reversal, you're probably 2 to 3, 4 weeks anyway, net bullish once the weekly makes a bull reversal. Well, the daily, just the day before, it made a bull reversal. So as of that Friday, this market has just made a dual time frame weekly daily momentum bullish reversal. They're both in sync with each other to continue a bull trend. And more than likely, it's going to immediately continue because the daily momentum just made a bull reversal the day before. So we would look at IYR as in an immediate position to consider a long trade. Now, once again, we're not considering pattern, we're not considering price relationships, but we just can't ignore that this is very much looks like a corrective pattern. And so if we get a weekly momentum bull reversal after a market's been in a corrective pattern for some time, we certainly have the possibility that that correction could be complete. But right now, immediate position for a long trade. So what's the trade strategy? Well, there's a couple real logical and simple strategies we could have. Typically, when I see a dual time frame momentum reversal position like IYR just made, is go long in the next higher close. It's that simple. As long as the daily momentum has not reached into the overbought zone, and as long as, of course, it remains bullish. Another strategy, and as we used to do more in swing trading back in the day, so to speak, is just a close above the last swing high close. The reason I'm willing to do it on the next daily or the next higher daily close is because we've just made that reversal in the daily momentum, and that itself is usually followed by at least 2 to 3 or 4 days, if not longer, of net bull trend. So we're very close to that immediate reversal on the weekly data. So long in the next higher close. And where's the stop? Well, the stop is at the low made prior to entry, the low made prior to the daily momentum bull reversal. So once again, I usually on ETS, individual stocks, I'll put the stop at the close below the, we'll call it the momentum cycle low close and not the intraday low. So there we go. That's where the stop is going to be if we enter the market. I'll make it thick. So let's just add some data, see if we get stopped into the market, and then how we might manage the trade just based on momentum position. Didn't enter there, and boy, had a big entry there. Great setup actually, because not only did it have the higher close, it closed above the last swing high close, and that's really significant. So some people might say entry is too far from where the stop is. Just adjust your position size. Take a smaller position. It's that simple. You can adjust position size so your capital exposure is acceptable for your trading plan and with the parameters of your trading plan. Now, the last section of the course, we'll take a little bit more of a look at position size, that sort of thing. But for right now, don't pass up a signal like this, because this is literally about as good as it gets. Do you want to wait for a corrective decline? The problem with that is a lot of times you never get those nice corrections that allow you to position confidently on some correction after a bull trend's begun. That's why I'm always in favor of take that signal, even if it's a large stop, just do a smaller position size. And given that the daily momentum, even the fast line, hasn't reached overbought, and now that we've made a weekly momentum bull reversal, and if the trend's going to be sideways to up for a few weeks, it's going to probably very quickly reach overbought and probably hang in the overbought zone. That's real typical of the stochastic. Okay, so we're in the trade. What would be our trade strategy just based on dual time frame momentum as the days go on? Well, a couple of things. Number one is that at any time, while the weekly momentum is bullish and not overbought, any time that the daily momentum made a bull reversal, that would be a setup to either to add to the long position, and of course then to, when it makes a bull reversal, to adjust the stop. So let's add some data on here and see what we got. So there we go. We have the daily momentum has reached overbought. Let's see if it cycles and if we get another bull reversal. So now it just made a bear reversal, fairly significant decline compared with any other declines. It's obviously what we call a correction higher in degree and time and price in any correction so far. So it's making a corrective decline. So if the IYR, the daily momentum, makes a bull reversal and the market continues up, this will be a place where we'll adjust our stop to. Well, it didn't dip below the overbought zone, but it made a bull reversal within the overbought zone and then a new high. So obviously, we're going to bring our stop up to this level. So let's just do that. I like to color these in. I like to visually on any chart be able to see all the key information. Okay, let's continue to add some data. Well, this is just a relentless bull trend, isn't it? There we have another bear reversal from the overbought zone. And there we have, not yet a bull reversal. There we've made a bull reversal. Again, we didn't even get out of the overbought zone, but it's certainly a spot where we've had that momentum cycle reversal that we want to bring the stop closer to the market. And we've also made a new closing high. So if we looked at just at closing data, we can see that we made a correction and then a new closing high. So obviously we're going to bring our stop up close to the market. So now we get stopped out. We've got a pretty good profit if we were to get stopped out. That's locked in. What do I do? I want to make that thick. So we didn't buy the low. Okay, we're probably not going to sell the high, but we're going to get a good piece of the action here in between based on the dual time frame momentum position. Well, let's take a look at the weekly data again and see where the momentum is on the weekly. So this is the weekly data up through the last complete week from where we were at on the daily data, and the weekly momentums have been overbought, or the weekly momentum has been overbought for about 3 weeks, it looks like, and it's still overbought as of the end of the prior week. Being overbought, is that any kind of warning that a weekly high is near? Not necessarily. It would depend. We'd have to go back and look at maybe even a longer period of data to see during a strong bull market how long the weekly momentum tended to be overbought before it made a bear reversal. But I'm just going to not make that kind of judgment. I'm going to say as long as that weekly momentum is positive, is bullish, we have the potential to continue this weekly bull trend. And once it makes a bear reversal, that'll be the first weekly bear reversal since going all the way back to around this weekly high. And that'll be fairly significant, meaning if it makes a bear reversal, and then particularly if it comes down out of the overbought zone after that bear reversal, is more than likely it's made a weekly high. And then it'll be sideways to down for at least a few weeks. So let's go back to the daily data, and we're still looking for setups to continue a bull trend and daily momentum setups to advance the stop based on the reversals in the daily momentum if the market continues to advance. So let's add some data onto here. We just adjusted the stop because we made a daily momentum bull reversal, and then we made a new closing high. So we brought the stop closer to the market. Now, again, we're not looking at pattern or price relationships, but take a look at this advance from that low. Look familiar? Do you think there might be some other useful information we could use for adjusting the stop? Well, certainly looks like a 5-wave advance, doesn't it? Looks like we're in wave 5. Once again, we'll get to that later on, but boy, once you've got Elliott wave eyes, you're just always looking at a market in basic patterns. And so when you have a basic pattern like this, you just can't ignore it. Okay, let's add some data on here and see if how the momentum might help us out. So, continued higher. Is there any reason to adjust the stop based on momentum? Well, not yet. Well, whoa, what a bear reversal we made there in the daily momentum. And this is, what is this? It's a 4 close outside reversal day. That's a day where you close below the closes of the past 4 days. That's a pretty significant reversal when it made this daily momentum bear reversal. What else has happened? We haven't exited this market yet because we haven't closed below 88.30. But what else is useful information here? Well, isn't this just a classic momentum price bearish divergence where we had a new price high, including new closing highs, yet the momentum cycle high was at a lower level? That basically is representing the market's running out of buying power. It's running out of the strength in the market, and that's a bearish divergence. That's frequently a warning of a bearish reversal coming up. And I would say right now it's probably happened. Let me add a date. Oh, there's the next day. If we were still exiting on the close, we exited on the close right there. So, boy, just made a pretty minimal gain on this advance over 3 or 4 weeks here. And it was significantly higher at one point in time. But if we're just basing our strategy on dual time frame momentum, and that's the lessons we're learning here, we're basing our strategy on that and adjusting our stops. We still came out with a profit, not just a lot of profit for that amount of time that we're in the trade. So that's why you're going to see, once we introduce the pattern and price relationships, how we can significantly, in most cases at least, improve our profit and profit potential. So IYR, very soon after getting stopped out, within a week or so, continued its significant bull trend for many more weeks, even months, and very soon made another bull reversal in the weekly momentum. So this correction only lasted, I think it was less than 2 weeks, and we could go through the whole process again, but it's basically the same as here. The next weekly momentum bull reversal was again a setup to consider long trades on weekly momentum, or excuse me, on the daily momentum bull reversals. So the process is the same, almost a standalone trade strategy, although I wouldn't recommend that at all, using just dual time frame momentum positions to position in the market. But when we combine that with the price and pattern relationships, you'll find what a great opportunities are opened up to us when we combine the dual time frame momentum with the price and the pattern position. So, that said, let's do that. Let's go into another chapter and look how we put all of this together.